carefully reviewing economic developments. Recent indicators suggest that economic activity has been expanding at a strong pace and well above earlier expectations. In the third quarter, real GDP is estimated to have risen an outsized annual rate of 4.9%, boosted by a surge in consumer spending. After picking up somewhat over the summer, activity in the housing sector has flattened out and remains well below levels of a year ago, largely reflecting higher mortgage rates. Higher interest rates also appear to be weighing on business fixed investment. The labor market remains tight, but supply and demand conditions continue to come into better balance. Over the past 3 months, payroll job gains averaged 266,000 jobs per month, a strong pace that is nevertheless below that seen earlier in the year. The unemployment rate remains low at 3.8%. Strong job creation has been accompanied by an increase in the supply of workers. The labor force participation rate has moved up since late last year, particularly for individuals aged 25 to 54 years, and immigration has rebounded to pre-pandemic levels. Nominal wage growth has shown some signs of easing, and job vacancies have declined so far this year. Although the jobs to workers gap has narrowed, labor demand still exceeds the supply of available workers. Inflation remains well above our longer run goal of 2%. Total PCE prices rose 3.4% over the 12 months ending in September. Excluding the volatile food and energy categories, core PCE prices rose 3.7%. Inflation has moderated since the middle of last year, and readings over the summer were quite favorable. But a few months of good data are only the beginning of what it will take to build confidence that inflation is moving down sustainably toward our goal. The process of getting inflation sustainably down to 2% has a long way to go. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. As I noted earlier, since early last year, we have raised our policy rate by 5.25 percentage points, and we have decreased our securities holdings by more than $1 trillion. Our restrictive stance of monetary policy is putting downward pressure on economic activity and inflation. The committee decided at today's meeting to maintain the target range for the federal funds rate at 5.25% to 5.5%, and to continue the process of significantly reducing our securities holdings. We are committed to achieving a stance of monetary policy that is sufficiently restrictive to bring inflation sustainably down to 2% over time, and to keeping policy restrictive until we are confident that inflation is on a path to that objective. We are attentive to recent data showing the resilience of economic growth and demand for labor. Evidence of growth persistently above potential, or that tightness in the labor market is no longer easing, could put further progress on inflation at risk and could warrant further tightening of monetary policy. Financial conditions have tightened significantly in recent months, driven by higher, longer-term bond yields, among other factors. Because persistent changes in financial conditions can have implications for the path of monetary policy, we monitor financial developments closely. In light of the uncertainties and risks and how far we have come, the committee is proceeding carefully. We will continue to make our decisions meeting by meeting based on the totality of the incoming data and their implications for the outlook and for economic activity and inflation, as well as the balance of risks. In determining the extent of additional policy firming that may be appropriate to return inflation to 2% over time, the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored. Reducing inflation is likely to require a period of below potential growth and some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Howard Schneider with Reuters. Thank you, Chair Powell, for doing this. To what you referenced the rise in long-term bond yields, to what degree did that supplant action by the Fed at this meeting?
Thanks for your question. So I'll talk about bond yields, but I want to take a second and just sort of set the broader context in which we're looking at that. So if you look at the situation, let's look at the economy first. Inflation has been coming down, but it's still running well above our 2% target. The labor market has been rebalancing, but it's still very tight by many measures. GDP growth has been strong, although many forecasters are forecasting, and they have been forecasting, that it will slow. As for the committee, we are committed to achieving a stance of monetary policy that is sufficiently restrictive to bring inflation down to 2% over time. And we're not confident yet that we have achieved such a stance. So that is the broader context into which the strong economy and all the things I said, that's the context in which we're looking at this question of rates. So obviously we're monitoring, we're attentive to the increase in longer term yields, and which have contributed to a tightening of broader financial conditions since the summer. As I mentioned, persistent changes in broader financial conditions can have implications for the path of monetary policy. In this case, the tighter financial conditions we're seeing from higher long-term rates, but also from other sources like the stronger dollar and lower equity prices could matter for future rate decisions as long as two conditions are satisfied. The first is that the tighter conditions would need to be persistent, and that is something that remains to be seen. But that's critical. If things are fluctuating back and forth, that's not what we're looking for. With financial conditions, we're looking for persistent changes that are material. The second thing is that the longer term rates that have moved up, they can't simply be a reflection of expected policy moves from us that we would then, that if we didn't follow through on them, then the rates would come back down. So and I would say on that, it does not appear that an expectation of higher near-term policy rates is causing the increase in longer-term rates. So in the meantime, though, perhaps the most important thing is that these higher Treasury yields are showing through to higher borrowing costs for households and businesses, and those higher costs are going to weigh on economic activity to the extent this tightening persists. And the mind's eye goes to the 8%, near 8% mortgage rate, which could have pretty significant effect on housing. So that's how I would answer your question.
Just as a quick follow-on to be clear on this, in your opening statement and just now, you seem to imply that you are not yet confident that financial conditions are restrictive enough to finish the fight. Is that true?
Yes, that's exactly right. To say it a different way, we haven't made any decisions about future meetings. We have not made a determination, and I will say that we're not confident at this time that we've reached such a stance. We're not confident that we haven't. We're not confident that we have. And that is the way we're going to be going into these future meetings, is to be, just determining the extent of any additional further policy tightening that may be appropriate to return inflation to 2% over time.
Gina. Hi, Chair Powell. Thank you so much for taking our questions. I wonder, if you don't raise interest rates in December, would the presumption be that at that point that we should expect that rates are at their peak, or is there a possibility of restarting rate increases next year? And are there any costs to taking a more extended pause?
So Let me start by saying we haven't made a decision about September. You're asking a hypothetical there, but we're going into this December meeting. We'll get, as you know, 2 more inflation readings, 2 more labor market readings, some data on economic activity, and so we'll be taking, and also the broader situation, the broader financial condition situation, and the broader world situation. We'll be looking at all those things as we make a decision in December. We haven't made that decision. I would say though that the idea that the idea that you would be difficult to raise again after stopping for a meeting or two is just not right. I mean, the committee will always do what it thinks is appropriate at the time. And again, we haven't made any decisions at all about December. We didn't talk about making a decision in December today. Really, it was a decision for this meeting and understanding broader things.
Nick Timmeros of the Wall Street Journal. Chair Powell, did the Fed staff put a recession back into the baseline forecast in the materials for today's meeting? And how much does this tightening in financial conditions substitute for rate hikes if the tightening is persistent? You had said it was worth maybe a quarter point when we had the bank failures in the spring. What is it here on something that's presumably more straightforward and more familiar to simulate?
So I guess I don't want to answer your question about the recession, but the answer is no. I think I have to answer it since we did publicly say in the minutes. You'll know anyway in the minutes. The staff did not put a recession back in. I mean, it would be hard to see how you would do that if you look at the activity we've seen recently, which is not really indicative of a recession in the near term. In terms of how to think about translation into rate hikes, I think it's just too early to be doing that. And the main reason is we just don't know how persistent this will be. You can see how volatile it is. Different kinds of news will affect the level of rates. I think any kind of an estimate that was, precise would hang out there and have a great chance of looking wrong very quickly. So I think what we can say is that financial conditions have clearly tightened, and you can see that in the rates that consumers and households and businesses are paying now. And over time, that will have an effect. We just don't know how persistent it's going to be, and it's tough to try to translate that in a way that I'd be comfortable communicating into how many rate hikes that is.
If I could follow up, I guess what makes you confident that tighter financial conditions will slow above trend growth when 500 basis points of rate hikes, QT, and a minor banking crisis have not thus far?
Well, that's the way our policy works is, and sometimes it works with lags, of course, which can be long and variable. But ultimately, if you raise raise interest rates, you do see those effects, and you see those effects in the economy now. You see what's happening in the housing market. You're seeing that now. You'll see if you look at surveys of people, it's not a good time, they think, to buy durable goods of various kinds because rates are so high now. I mentioned again, we're getting reports from housing that the effects of this could be quite significant. But you're right. This has been a resilient economy, and it's, I think, been surprising in its resilience. And there are a number of possible reasons why that may be. Our job is to achieve maximum employment and price stability, and so we take the economy as it comes. It has been resilient, so we take it as it is.
Thank you. Colby Smith with the Financial Times. In terms of the thresholds that you've laid out of what could warrant further tightening, the additional evidence of persistently above trend growth or some kind of reversal in the recent easing of labor market tightness, that seems to suggest something more powerful than just one more quarter point rate hike would be necessary. And I'm just curious if that's how the committee sees it.
So we've identified those factors. Those are not meant to be the only factors or a specific test that we're going to be applying with some metrics behind it. Really, we're going to be looking at the broader picture and what's happening with our progress toward the 2% inflation goal. Is the labor market continuing to broadly cool off and achieve a better balance? We'll be looking at that. Growth, we look at growth insofar as it has implications for our 2 mandate goals. We look at that. And we look at broader financial conditions. So we'll be looking at all of those things as we reach a judgment, whether we need to further tighten policy. And if we do reach that judgment, then we will further tighten policy.
Okay. And just in terms of the tightening of financial conditions, if that is having some kind of offsetting effect in terms of the need to potentially, again, raise rates, what then is the potential impact on the trajectory of rate cuts? Could we see those maybe pulled forward or have to see more than what the September SEP indicated?
So the fact is the committee is not thinking about rate cuts right now at all. We're not talking about rate cuts. We're still very focused on the first question, which is, have we achieved a stance of monetary policy that's sufficiently restrictive to bring inflation down to 2% over time, sustainably? That is the question we're focusing on. The next question, as you know, will be, for how long will we remain restrictive? Will policy remain restrictive? And what we said there is that we'll keep policy restrictive until we're confident that inflation is on a sustainable path down to 2%. That'll be the next question. But honestly, right now, we're really tightly focused on the first question. The question of rates cuts just doesn't come up because I think it's so important to get that first question, as close to right as you can.
Steve Leisman, CNBC. Mr. Chairman, I guess I had assumed that there was a tightening bias in the committee. You say in the statement you're looking to assess the appropriate stance of monetary policy, the extent to which you may need to hike additionally. You didn't say earlier that you were sufficiently restrictive. There were forecasts for 2 rate hikes among most members of the committee. But then you just said that, we haven't made a determination. Would you say the bias right now is neutral, that there is no disposition to hike again, and that the committee largely has moved off of this forecast for 2 hikes? Or for one additional
I
hike?
think you're talking about one additional.
Yeah,
I wouldn't say that at all. I would say, the language, looking at it here, in determining the extent of additional policy firming that may be appropriate to return inflation 2% over time, that's the question we're asking.
So is it right to think of that as a hiking bias is still in the committee here?
We haven't used that term, but it's fair to say that's the question we're asking: is should we hike more? It's not, and that is the question. And you're right that in September we wrote down one additional rate hike, but and we'll write down another forecast, as you know, in December.
Thank you, Chris Rugaber at Associated Press. Well, since the last meeting, the auto workers' strike has finished. Oil prices have leveled off. And yet, on the other hand, you have the outbreak of war between Israel and Hamas. How do you see all those factors taken together affecting the economy going forward? How are you thinking about those?
So there are significant issues out there. As you point out, global geopolitical tensions are certainly elevated. And that goes for the war in Ukraine. It goes for the war between Israel and Hamas. We're monitoring that. Our job is to monitor those things for their economic implications. So the UAW strike, as you point out, appears to be coming to an end. Oil prices have flattened out. They haven't gone down, but I guess they've gone down a little bit from their earlier peak. Another one is the possibility of government shutdown. We don't know about that one. So there's plenty of risk out there. But I would go back to the bigger picture from our standpoint is we've got a very strong economy, strong labor market, making progress on the labor market, making progress on inflation. And we're very focused on getting confident that we have achieved a stance of monetary policy that is sufficiently restrictive. That's really our focus.
Great. And just one quick thing. You last month had gone to York, Pennsylvania, where you talked to last month, where you talked to a lot of small business owners. Just curious, what sentiments did you hear from them, or what did you pick up on, and was there anything that surprised you the most in terms of what they talked about?
I wouldn't say I was terribly surprised. I was very impressed by York as a town with a real strategy, and I would say it's very impressive what the people there have put together in the face of some difficult longer run trends about offshoring of manufacturing and that kind of thing. They've done a great job as a city, I think. What you hear, and is consistent there, which is people are really suffering under high inflation. You were there. We talked to some people who, were feeling that in their businesses, and other people who were feeling it in their home lives as well. It's painful for people, particularly people who don't have a lot of extra financial resources, who are spending most of their incoming income on the essentials of life. So we know that that wasn't new, but that did come through very clearly in the conversations we had in New York. And I walked away from that even, I mean, just thinking that we really the best thing we can do for the U.S. is to restore price stability, fully restore price stability, and not fail in that task, and do it as quickly as possible, but also with the least damage we can.
Rachel. Hi, Chair Powell. Rachel Siegel from the Washington Post. Thanks for taking our questions. You've spoken before about the pain that would likely be coming for the economy in order to get inflation down. But since the economy has not responded to rate hikes in ways that would normally be expected, have you changed your views on that at all, on how necessary or inevitable that kind of pain would be, say, for the labor market or overall growth?
Well, I think everyone has been very gratified to see that we've been able to achieve, pretty significant progress on inflation without seeing the kind of increase in unemployment that has been very typical of rate hiking cycles like this one. So that's a historically unusual and very welcome result. And the same is true of growth. We've been saying that we need to see below potential growth, and growth has been strong, but yet we're still seeing this. I still believe, and my colleagues, for the most part, I think still believe that it is likely to be true. It is still likely to be true, not a certainty, but likely that we will need to see some slower growth and some softening in the labor market conditions to get to fully restore price stability. So, but it's only a good thing that we haven't seen, and I think we know why. Since we lifted off, we have understood that there are really two processes at work here. One of which is the unwinding of the distortions to both supply and demand from the pandemic and the response to the pandemic, and the other is restrictive monetary policy, which is moderating demand and giving the supply side time to recover, time and space to recover. So you see those two forces now working together to bring down inflation. But it's that first one can bring down inflation without the need for higher unemployment or slower growth. It's supply side improvements like shortages and bottlenecks and that kind of thing going away. It's getting a significant increase in the size of the labor market now, both from labor force participation and from immigration. That's a big supply side, gain that is really helping the economy. And it's part of why GDP is so high, is because we're getting that supply. So we welcome that. But I think those things will run their course, and we're probably still going to be left, we think, and I think, we'll still be left with some ground to cover to get back to full price stability. And that's where monetary policy and what we do with demand is still going to be important.
I'm curious, against that backdrop, if you've gotten any clarity on lags, if you have an economy that's been so resilient to high rate increases, does that suggest to you that there isn't necessarily this huge wave of tightening that's still coming through the pipeline, and that it may have already come into effect?
I continue to think it's very hard to say. So it's been 1 year at this meeting. 1 year ago, this was the fourth of our 75 basis points hikes. So that's a full year since then. I think we are seeing the effects of all the hiking we did last year, and this year we're seeing it. It's very hard to know exactly what that might be. But you can, for example, an example of where you wouldn't have felt this yet is debt that had been termed out, but it's going to come due and have to get rolled over next year or the year after. So, and there are little things like that where the effects are just taking time to get into the economy. So I think we have to make monetary policy under great uncertainty about how long the lags are. I think trying to get a clear answer and say, I'm just going to assume this, is really not a good way to do it. And this is one of the reasons why we have slowed the process down this year, was to give monetary policy time to get into the economy. And it takes time, we know that, and you can't rush it. So slowing down is giving us, I think, a better sense of how much more we need to do if we need to do more.
Michael McKee from Bloomberg Television and Radio. I'm trying to connect the dots here. One quick clarification I want to ask about Rachel's question is, you said you need slower growth. You had always said before a period of lower than trend growth. Has that changed? And two, it sounds to me like you're basically saying here that the kind of the dot plots out the window, that every meeting is live with the possibility of a rate increase for right now. It doesn't matter about the turn of the year, and that there's not an objective way to determine whether or not you've got enough tightening in the system. It's just going to be a subjective judgment meeting by meeting.
Well, so let's talk about the dot plot first. So the dot plot is a a picture in time of what the people on the committee thinks is likely to be appropriate monetary policy in light of their own personal economic forecast. In principle, when things change, that's not like a plan that anybody's agreed to or that we will do. That's a forecast that would change. For example, I mean, many things could change that would cause people to say, I wouldn't write down that dot, 6 weeks later. Think of the number of things that could change your mind on that. So I think the efficacy of the dot plot probably decays over the 3-month period between that meeting and the next meeting. But nonetheless, it's out there, and we do personally update our forecast, but we don't formally update the dot plot. So, I think we try to be as transparent as we can about the way we're thinking about these things. We're laying out there our thinking, and as we approach the meeting, we'll all be, my colleagues and I will be talking about how we're processing that data. In terms of, we're not really changing the way, in terms of growth, what I said was below potential. So what you have here recently is growth that is temporarily, potential growth is elevated for a year or two right now over its trend level. So the right way to think about it is what's potential growth this year. People think trend growth over a long period of time is a little bit less than 2%, or I would say just around 2%. But what we've had is with the improvement in the size of the labor force, as I mentioned, through both participation and immigration, and with the better functioning in the labor market, and with the unwinding of the supply chain and shortages and those kinds of things, you're seeing actually elevated potential growth. There's catch-up growth that can happen in potential. And that means that if you could be growing at 2% this year and still be growing below the increase in the potential output of the economy. I hope that's clear. That's really what's going on. That's why I would say it as below potential.
But if you could clarify what I asked about meeting by meeting, are we essentially now supposed to assume that it's a meeting by meeting, live meeting with a chance of a rate increase that will be decided on subjective criteria rather than objective at each meeting?
I don't know that I want to just accept anybody's characterization of it. I'll tell you how we're doing this. So we're going meeting by meeting. We're asking ourselves whether we've achieved a stance of policy that is sufficiently restrictive to bring inflation down to 2% over time. That's the question we're asking. We're looking at the full range of economic data, including financial conditions and all of those things that we look at. And then we've come very far with this rate hiking cycle, very far. And you saw the spread at the September meeting of, it's a relatively small spread of people think 1 or 2 additional hikes. So you're close to the end of the cycle. That was an impression as of a belief as of September. It's not a promise or a plan of the future. And so we're going into these meetings one by one. We're looking at the data. As I mentioned, we're also, we're being careful. We're proceeding carefully because we can proceed carefully at this time. Monetary policy is restrictive. We see its effects, particularly in interest-sensitive spending and other channels. So that's how I think about it.
Neil. Thanks. Hi, Chair Powell. Neil Irwin with Axios. In light of the run-up in long-term yields we've seen the last several weeks, have you given any consideration to the pace of your asset runoff program? And if there were a judgment that the higher term premium was endangering the dual mandate goals, would that be reason to think about slowing or suspending QT, or should we think of that as more of a technical question around reserves?
So committee is not considering changing the pace of balance sheet runoff. It's not something we're talking about or considering. And I know there are many candidate explanations for why rates have been going up, and QT is certainly on that list. It may be playing a relatively small effect, although I would say at $3.3 trillion in reserves, it's not. I think it's hard to make a case that reserves are even close to scarce at this point. So that's not something that we're looking at right now.
Victoria.
Hi, Victoria Guido with Politico. I wanted to ask about the Basel III endgame capital proposal. You've gotten a lot of pushback from people on different aspects of the proposal, and you yourself expressed some reservations. And I'm just curious, could you accept finalizing that proposal without significant changes?
So that proposal is out for comment, and we expect a lot of comment. We won't get those comments until the end of, well into next year. We've extended the deadline, and we'll take them seriously. We'll read them. I'll say what I do expect is that we will come to we're a consensus-driven organization. We'll come to a package that has broad support on the board.
So does broad support mean more support than the proposal had?
It means broad support.
Janelle Marte with Bloomberg. So in addition to persistence, when you look at long-term treasury yields, what else are you watching to evaluate how those tighter financial conditions are hitting the economy and if it will lessen the need for further tightening? Also, do you think that those higher yields could affect banking stress?
So what do we look at? We look at a very wide range of financial conditions. And in fact, as you'll know, different organizations publish different financial conditions indexes, which can have 7 or 8 variables, or they can have 100 variables. So there's a very rich environment, and we tend to look at a few of them. I'm not going to give you the names, but they're a few of the common ones that people look at. And so they're looking at things like the level of the dollar, the level of equity prices, the level of rates, the credit spreads. Sometimes they're pulling in credit availability and things like that. So it isn't any one thing. We would never look at, for example, long-term treasury rates in isolation, nor will we ignore them. But we would look at them as part of a broader picture. And they do play a role, of course, in many of the major standard financial condition indexes. Your second question was banking stress. So it's something we're watching. As you know, we did have there were issues with interest rate risk and also funding uninsured deposits in the March, the things we went through in March and thereafter. And so we've been working a lot with financial institutions to make sure that they have good funding plans and that they have a plan for how to deal with the kind of portfolio unrealized losses that they have. We do think the banking system is quite resilient. We had a handful of bank failures, but so that's what we're out there doing, and we don't have any reason to think that these rate hikes are materially changing that picture, which is one of a strong banking system and one where there's a strong focus by banks and by supervisors on liquidity, on funding, and those sorts of things.
Thanks, Mr. Chairman. Scott Horsley from NPR. Last week, you and your colleagues put forward a proposal to lower the cap on debit card swipe fees for comment. Could you just talk a little about the considerations there, what it would mean for merchants, for banks, for consumers, and also just what y'all are seeing in terms of the use of both debit and credit cards in the payment system?
So you're right. We put a proposal out for comment is what we did. And this is a job that Congress assigned us, as you of course know, in Dodd-Frank, and all we can really do is faithfully implement the statute. That's all we're trying to do. What else can we really do? It's a 90-day comment period. We typically don't comment on these things once they're out for comment, and we do hope that stakeholders, and we know that they will use this opportunity to express their views. They haven't been shy about that. So that's critical, and that's what I can say about that now.
Thank you. Thanks, Chair. Edward Lawrence with Fox Business. So over the last 3 months, the year-over-year PCE inflation was at 3.4%, core well over 3%. You've said in the past 2% remains the Federal Reserve target, but with no rate increase today, how long would you be okay then with a 3% or 3% plus overall inflation?
The progress is probably going to come in lumps and be bumpy, but we're making progress. I think the core PCE came down by almost 60 basis points in the third quarter. So the best thing I could point you to would be the September SEP, where the expectation was that inflation by the end of next year on a 12-month trailing basis would be well into the twos, and the year after that further into the twos. So that's if you look historically, that's sort of consistent with the way inflation comes down. It does take some time, and as you get as you get further and further from those highs, it may actually take longer time. But the good news is we're making progress, and monetary policy is restrictive, and we feel like we're on a path to make more progress, and it's essential that we do.
Well, you've said in the past that doing too little on interest rates could take years to fix, but the cost of doing too much could be easily fixed. How robust was the debate about this pause on the doing too little side?
That's always the question we're asking ourselves, and we know that if we fail to restore price stability, the risk is that expectations of higher inflation get entrenched in the economy, and we know that that's really bad for people. Inflation will be both higher and more volatile. That's a prescription for misery, and so we're really committed to not letting that happen. For the first year or so of our tightening cycle, the risk was all on the side of not doing enough. We've come far enough that the risks have gotten more two-sided. You can't identify that with a lot of precision, but it does feel like the risks are more two-sided now. But we're committed to getting inflation back down to our target over time, and we will.
Simon Rabinovich with The Economist. Quick follow-up to the question about banking stresses. You talked about how the banking system is resilient. Of course, part of the resilience of the past year stems from the bank term funding program that you launched in March. Given that bond prices have not recovered, that unrealized losses are probably mounting, how likely is it that you might have to extend that program in March next year?
Good question. We haven't really been thinking about that yet. It's November 1, and that's a decision we'll be making in the first quarter of next year.
Okay. Sorry, quick separate question about inflation expectations. The Michigan Sentiment Survey showed a big jump in 1 year ahead inflation expectations last month from 3.2 to 4.2. Last year, you said that particular survey was a really decisive factor in one of your rate hike decisions. If it stays elevated next time around, how big of an input will that be into your December thinking?
Yeah, we look at a range of things. I think the thing got blown out of proportion a little bit. It was actually a preliminary estimate that got revised away, and I said it was preliminary but that didn't get picked up. So we look at many things, and so really look across the broad array of surveys and also market-based estimates, and we do that really carefully at every meeting and between meetings. And it's just clear that inflation expectations are in a good place. The public does believe that inflation will get back down to 2% over time, and it will. They're right. So, and there's no real crack in that armor. You can always find one reading that is a little bit out of whack, but honestly, the bulk of them are just very clear that the public believes that inflation will come down, and that's, of course, we believe that's critical in winning the battle.
Hi, Chair Powell. Megan Casella with Barron's. Thanks for taking our questions. I wanted to see if you could talk about the neutral rate. You mentioned today that you're still debating whether rates are sufficiently restrictive, and you've recently said that evidence is suggesting policy is not too tight right now. So I was curious if you could elaborate on that at all and whether that means the neutral rate, in your view, has risen.
Yeah. So first thing to say is that it's very important. It's a very important variable in the way we think about monetary policy, but you can't identify it with any precision in real time, and we know that. So you have to just take that. You have to take your estimate of it with a grain of salt. What we know now is, within a range of estimates of the neutral rate, policy is restrictive, and it's therefore putting downward pressure on economic activity, hiring, and inflation. So we do talk about this. There's not any debate or attempt to sort of agree as a group on whether R-star has moved or not. Some people think it has. Some people haven't said that don't think it has. Ultimately, it's unknowable. And so really, again, what we're focused on is, looking at the data and giving ourselves a little more time now to look carefully at the data by being careful in our moves. Does it feel like monetary policy is restrictive enough to bring inflation down to 2% over time? That's the question we're asking ourselves. I think, years from now, economists will be revising their estimates of R-star as it existed on November 1, 2023. We can't really wait for that in making policy. We have to we have to have those models and look at them and think about them, but ultimately we've got to look at the effects of that policy is having, accounting for the lags, which makes it difficult.
If I could follow up on a wages point earlier, you talked about the inflation outlook, but I'm curious if you have any concerns whether wage inflation at its current level could risk pushing up overall inflation or reacceleration.
So if you look at the broad range of wages, they have wage increases have really come down significantly over the course of the last 18 months to a level where they're substantially closer to that level that would be consistent with 2% inflation over time, making standard assumptions about productivity over time. So it's much closer than it was. And that's true of the ECI, which is the one that we got this week. It's true of average hourly earnings and compensation per hour too. So, and all of them are kind of saying that, which is great. And you have to look at a group of them because any one of them can be idiosyncratic in any given reading. So that's what you see. And so what you saw with the ECI reading was, if you look back comes out 4 times a year. If you look back a couple of quarters, you'll see it was much higher, and then it came down substantially in June. And then the September reading was more or less at the same level as the June reading. So in a way, it's just validating that decline. And it was very close to our expectations internally too. So I think we feel good about that. Also, I would say it isn't, in my thinking, it's not the case that wages have been the principal driver of inflation so far. Although I do think it's fair to say that as we go forward, as monetary policy becomes more important relative to the supply side issues I talked about and the unwinding of the pandemic effects, it may be that the labor market becomes more important over time too.
Hi, Nancy Marshall-Genzer with Marketplace. Chair Powell, are you now as concerned about overshooting and raising interest rates too much as you are about getting inflation down to the 2% target?
So as I mentioned, I think for much of the last year and a half, the concern was not doing too much, not doing enough. It was not getting rates high enough in time to avoid having higher inflation expectations become entrenched. So that was the concern. I think we've reached now more than 18 months into this. You can see by the fact that we have slowed down, although we're still trying to gain confidence in what the appropriate stance is. But you can see that we think, and I think, that the risks are getting more balanced. I'll just say that they're getting more balanced. The risk of doing too much versus the risk of doing too little are getting more closer to balance, because policy is clearly restrictive at 5.25% to 5.5%. That range, if you take off a mainstream estimate of the expected inflation, take 1 year inflation, you're going to see a real policy rate that is well above mainstream estimates of a neutral policy rate. Now that's arithmetic. It doesn't really, what the proof is really in how the economy reacts. But I would say that we're in a place where those risks are getting closer to being in balance.
And you said the proof is how the economy reacts. What are you looking at to be sure you're not overshooting?
Well, I think what we're looking at is, is inflation still broadly cooling? Is it sort of validating the path we saw over the summer, where inflation was clearly cooling and coming down? Now, we've seen periods like that before, and there hasn't been follow through. The data have bounced back. So what are we seeing? Are we seeing, is inflation still coming down? So that's the first thing. Second thing is, in the labor market, what we've seen is a very positive rebalancing of supply and demand, partly through just much more supply coming online, and with labor demand still clearly remaining very strong. When you have the kind of job growth we've had over the last quarter, it's still very strong demand. So, and you see wage increases coming down, as we discussed, but coming down, in a kind of gradual way. I think that's we want to see that whole set of processes continue.
Brian Mena, CNN. Do you think that has been any structural change in either consumption or in the job market that's pushing up consumption? You obviously saw the third quarter GDP figures, which were strong, and some economists have expected revenge spending to have fizzled out by now. So I'm kind of wondering if there's been any structural change in consumption.
I wouldn't say there's been a structural change in consumption. I would say it's certainly been strong. And so a couple of things. We may have underestimated the balance sheet strength of households and small businesses, and that may be part of it. There may be, we've been, like everyone else, trying to estimate the amount of savings that households have from the pandemic when they couldn't spend on services really at all, or in-person services. And, there can still be more of that than we think, although at a certain point we're going to be getting back to pre-pandemic levels of savings. We may not be there yet. So clearly people are still spending. The dynamic has been really strong job creation, with now wages that are higher than inflation in the aggregate anyway. And that raises real disposable income, and that raises spending, which continues to drive more hiring. And so you've had that whole dynamic has been, and also at the same time, the pandemic effects are wearing off, so that goods availability, automobile availability is better, or was better. I think it still is. And from a business standpoint, there are more people to hire, and there's more labor supply. So the whole thing has led to more growth, more spending, and that kind of thing. And it's been good. And the thing is, we've been achieving progress on inflation in the middle of this. So it's been a dynamic. The question is, how long can that continue? And I just think the existence of this second set of factors at this time, which is the unwinding of the pandemic effects, that's what makes this cycle unique, I think. And we're still learning. Took longer for that process to begin than we thought, and we're still learning about how it plays out. That's all we can do.
So to Daniel for the last question.
Thank you, Chair Powell. Daniel Avis from Agence France Presse. Just a quick question following up on an earlier one with regards to the Israel-Hamas conflict. The Fed's financial stability report said the Israel-Hamas conflict and the conflict in Ukraine pose important risks to global economic activity, including the possibility of sustained disruptions to regional trade in food, energy, and other commodities. You've had organizations like the World Bank warning of a possible surge in oil prices if the war spreads to other countries in the region. I'm just wondering how the Fed is monitoring these developments in the Middle East. You mentioned they are, and just what the potential economic impact could be if the conflict does spread to other countries in the region. Thank you.
I wouldn't want to speculate too much, but I'll just say, so, really the question there is, does the war spread more widely, and does it start to do things like affect oil prices in particular, since this is the Middle East we're talking about? The price of oil has really not reacted very much so far to this. As the Fed, as the Federal Open Market Committee, our job is really to understand the economy and the economic effects. And it isn't clear at this point that the conflict in the Middle East is on track to have significant economic effects. That doesn't mean it isn't incredibly important and something for people to take great, really important notice of, but it may or may not turn out to be something that matters for the Federal Open Market Committee as an economic body. But what the Financial Stability Report does is it calls out risks, and that's what it's doing, is calling out a risk of that. And the war in Ukraine, the same. war in Ukraine, did have immediately very significant macroeconomic implications because of the connection to commodities. So thank you.
Thank you.
Thanks very much.
All right. Now end, but you out there, don't go anywhere, team. I'm going to pull this down. We're going to go ahead and review what was actually said here, what was important on this FOMC conference, right? And what maybe had been different from what was said in the report. And that's a prepared speech that's given out. That's what he read at first, compared to the Q&A, because that's truly where we get the good stuff, the fireworks. That's when the market started moving. So let's talk all about that. And you guys in the chat, let me know what was your comment that shook you a little bit on this conference. Let's get to the action. Let's talk all about the highlights. First, I'm going to go through some of the highlights. Of course, what did I do? I used a couple of different things to do this. So of course, AI is helping me on this. And I always talk about using AI for things like this. But if you guys want to learn how I can do this a little bit more of, is I get the captions, the actual spoken words from this. You guys can get this from the Federal Reserve site. There's a link right on there for you guys to get the live captions and do this yourself, right? I know the traders are trying to make money, trying to be fast and quick using different things like AI. So I just wanted to give you guys that insight on how I deliver it. Let's get to the action. Let's take a look at what happened here. Of course, in the they kept rates right where they are, right? Now, what was different that was said, of course? Inflation concerns. Jerome Powell emphasized that the Federal Reserve commitment to addressing inflation and the importance of restoring price stability, right? And right now, we're getting a move that's very important. So I'm going to interrupt some of the highlights to show you guys the price action, because this is what you guys want, especially my traders out there. I talked about it earlier, and I could scroll up and find my chat comment there, but look at this. I said, look to see if the TLT can break the 85 spot. If that happens, I could see the market continuing going towards the upside. So we'll see what happens there. Definitely getting a nice little move. Let's go to the Qs. And I was looking at the hourly, and I talked about this also in the chat. This is one of my important things. Whenever there's kind of extreme volatility, especially in the intraday, I'm going to go to the hourly, if not the 4-hour chart. What is that going to help me do is get around the first wick that happened when we were speaking, right? What happened here? Well, if you go to the 1 minute, you'll see it really how this was kind of shaking up here. Right out the gates, we went up to 350. What was that high here? 355.45, and then came all the way back down towards like 352.63. Now, if you were looking at the hourly candle, you just kept it simple. This is a bullish pattern. If I break support, I'll be concerned. So I clearly stated that look for maybe to see if you break the 352 spot. If you can break that 352 spot, maybe we can come back down through what? The opening price. The opening price today was 351.16. And that's so vital here because we're looking to see what? We're looking to see if we're going to break that on the downtrend and start to break down on the TLT. Actual opposite. You get the downside action move, and then you get the close back above this closing price around the 454.23s, 454.25s, you want to call it. Doesn't really matter. As long as this candle can close above this high, you're looking stronger. Where is this candle close? Right above it. You see how it's right above it? That showed me strength. Now it doesn't even give you the throwback look. And now it really starts to drive off this 355. Let's see what else is going on in the market. And Jay, you might be right. Maybe the market's ripping because Kramer was bearish last night. But the train has left the station, EKS. And a big part of that is what I see happen often. So a lot of the times what happened? Well, we had a very bearish day on that Thursday, right? When we started to turn things around. And when did it start to come back? Towards the end, right? And I think that this is so important, kind of catching these moments where you see these runs. When do they happen? Usually in the middle of the day. A lot of the times I've seen them. And to me, that's when institutions take over. They drive the market higher and they try to push it so far past that the bulls even feel like the move has already come and the train has left the station. So good. Good comments there, EKS. We'll take a look at what else is going on in the markets. Of course, if you guys have stocks to take a look at, throw them up in the chat. I'm going back to some of the highlights. We can keep watch on the action right now, but definitely something to keep an eye out for. And just look at the stocks and look how they're moving right now. The leadership. This is why it's so important to stick with leadership, right? If I take a look here, look at our leaders today. Apple driving higher. Microsoft driving higher. Even Tesla that was red could go green now. Look how this is starting to reverse. Well, a lot of this is that nice big action up. And believe it or not, I actually made money shorting NVIDIA today. I'll tell you one thing. I ain't going shorting NVIDIA again. It's getting a nice rip higher here towards the 420 spot. 421 now. We'll see what happens. Definitely multiple stocks making big moves. Let's go back to the action. Let's go back to the highlights. One thing that I wanted to state was on the policy stance. Chair Powell discussed the continuing debate with the committee regarding the stance of monetary policy and whether rates are sufficiently restrictive enough to actually get their initiative, which is bring the inflation back to 2%. Right? Rate hike expectation. He noted that the committee was not currently considering rate cuts. What? No pivot right now? Of course not. They're not going to tell you anything on pivots because that would mean that the economy was collapsing. They're not going to cut rates until they cut either two things. Either inflation stays at that sustained 2%. And he keeps using these words, right? Like sustained. What does sustained mean? In my eyes, that means that it not only needs to get down to 2%, but it needs to stay there. And that's so important. If it needs to stay at 2%, what will that need to mean? Well, that means to me that we need to get CPI or the PCE report, if you want to focus on what the Fed looks at, right? Not only at 2%, but there for multiple reports. What does that mean? Prolonged interest rates, guys, because that means that they would need to go ahead and see inflation go down to 2%, then wait to see if it stays at 2%. And then finally, as that happens, then they can start saying, hey, now we're going to start thinking about cutting. And does that mean that they'll cut there? No, that means they'll just mention that inflation is no longer their number one. And now their number one is focusing if the economy stays strong. This is so important. All right, let's see what else is going on. Yes, Mitch, but you do have bigger moves in laggards like Generac, SMG, Garmin, a few others. But to tell you the truth, man, I can't go longing Generac here, even though it's going higher. Do I believe this company is going to stay up? Maybe trade it here. But am I believing in investing in here or swing trading up here? At least myself, no, because in the long run, I see a tougher road in 24 than we had in 23. And why do I see that? Because regardless of what everyone's thinking, the consumer is slowing down. What are the airlines saying? There's no reason for airlines to cut like training and stuff like that if we're going to see the consumer stay strong. What did we see from Estee Lauder today? They told you guys those high-priced items are going to struggle. There is a lot of struggle out there. The only question is, are we seeing kind of a bottoming and are we going to drive for maybe like a month or two? Because that's the way I feel. If you guys feel that this is the start of a new bull market, let me know in the chat. I'd love to hear your outlook. If you guys think this is a new bull market, just throw up bull in the chat. I don't know if that means bull BS, but throw it up there. We'll see what happens, team. Let's keep going. And you guys out there, if you guys want to take a look at certain stocks, throw them up there also. I'll be catching you guys in the chat. It's good to be with you guys today. I know I was listening in on that conference call. A lot of things going on there. And one thing that was interesting was the bank talk. And I'll bring you guys the specific quote that was said in, of course, just earlier on the report, and then what was said in the kind of the Q&A, which was a little bit different, right? That's what we want to catch. What is different from the report that he got caught a little bit in the Q&A and didn't say the same thing? One of the biggest areas that I saw, and maybe it's just the bear in me, was this comment in the report, right? So I'll put it on the screen here so you guys can all read it with me, guys. Of course, actually, I think it's too long here, so I can just delete this part. the banking system. Let me go ahead and finish it because I don't want you guys to miss out on any of the words here. There we go. All right, so read this banner with me, guys. The U.S. banking system, of course, is sound and resilient, but tighter financial credit conditions for household and businesses are expected to weigh on economic activity, hiring, and inflation. So essentially, you're saying that things aren't going to get better for the banks because of what is going on in the current environment. But one thing that was said in the very beginning is kind of like an oxymoron, right? We're going to tell you that things can be weak, but we're also going to tell you that it's sound and resilient, that it's holding on, right? And then what was said in the actual Q&A, right? I have the question right here for you guys. This one really caught my attention, so I had to pull it, right? I couldn't help myself. Let's talk a little bit about that. So this was the second question that one of the journalists gave, and this was the question that was given. We have your second question was banking stress, and it has something to do with what we're watching. We did have that there's issues with interest rate risk, and you know that funding and uninsured deposits into March, the things that we went through in March and therefore after. So we have to keep working with a lot of financial institutions to make sure that they're good funding plans, that they have good funding plans and are good, and that they have a plan for how to deal with that kind of portfolio and unrealized losses that they have. Clearly telling you that the banks have big unrealized losses and we are helping them out. What are we doing? We're sustaining them, essentially keeping them alive. If we weren't there, where would these banks go? Well, you guys know how I feel about the regional bank action, and comments like this really tell me that there could be another crisis coming, because you can only hold these banks up for so long. Eventually, some of these regional banks, they might go. At least that's what I think. All right, let's keep going, team. Let's go into some other action. We can take a look at some of the stocks that are moving here. I don't mind even taking some trades. I'm actually thinking about opening up my account in just a second here so that I can get after it, take some live trades for you guys, even to the end of the day. But let's go through this. Let's take a look at what else is making a move in the market. If you guys got a ticker you guys want to check out, definitely throw it up in the chat. Let's go to the top movers of the day in the SPY. And of course, AMD leading the action there. And this was a really nice move yesterday. Of course, this one was a little bit of a shakeout on the earnings call, but what mattered is that you came really back to yesterday's close and you broke through the 100 and never retraced back to that 100. You got a little retracement here towards 127, but it pushed higher right off that VWAP and hasn't returned to VWAP, showing you that continued strength. Let's keep going. Let's go to some other names. I'm just going to keep rolling through them. These are the leaders of the SPY today. TT, building materials stock. I have no idea about Train Technologies, but I'll tell you one thing. I need to start paying attention to this one. Stocks that are leading right now. Look at these building materials. This is at what? An all-time high? Yeah, I think all-time high here. Yeah, doesn't look bad there. Garmin, of course, getting a nice little lift. You've talked about that one, Jay. So definitely seeing that one get a nice little push. DXEM pushing back. I actually really like this company. The only problem is I always get it wrong on the trades, guys. So I don't know what to do with Dexcom. Do I like the products that they have? I think they're really good medical devices. But the truth is, I don't have luck with this one. But moving through this, like trying to show you guys if there's any kind of trend here. This is a reversal trend here. WDC, after they did kind of an offering after their earnings, they got hit hard just recently, and it's back to 41. CVS today did have earnings and it was crushed in the morning, and the earnings weren't that great. The outlooks weren't that great, but they still bounced back. This is when we need to start paying attention. Are we getting ourselves a little bit of a rally? Yes, we are. Now, the only question that I think investors need to ask themselves is, how do you feel about this? Is this just kind of a little push back up to the upside? Or will this actually sustain the rally? Will we get back into a new bull market, right? Because the truth is, a lot of people are thinking that we never really got into a new bull market. We just had a bull run. We'll see what happens there, right? If we can continue climbing here, maybe we can show that soft landing narrative. The truth is, we haven't yet seen the destruction that the Fed usually leads to, which is what? Unemployment rate going higher. We have yet to see that happen. Those are kind of things that I will be looking for, especially after the holidays. One of the things that I can expect to see is that, yeah, there's usually a seasonal lift around this time. Then what usually comes? Well, you get the new January trade, right? Where maybe on January 1st, this still doesn't break, right? Because it's the new year type of trade. But going into February is really when I'm going to start looking for the decline in the overall market. So in the short term, what does that mean? Is that we can play these up to the upside. We can rent them. I don't like investments at these levels because I think eventually we retrace back through these levels. But do I like trades on these levels? Yeah, why not? Now we're getting another trend and we're catching a lot of shorts by surprise. So if you guys got shorts out there, like always, you determine if you want to cut them, but they're dangerous right now, especially in a market that's ripping back to the upside. All right, let's take a look at what else is going on there and what essentially happened here. Let's go to the daily chart. And I think this is important to notice is that we're finally starting to turn a little bit on the RSI. We still went sideways there for a couple days. And I think that was just trying to like resolve what would happen here on the Qs. And you guys can see here on the RSI how we were going down to that extreme and now are starting to turn around. This has room now to maybe even make it back to 370. So will I be trying to think that, yeah, this is coming right back down? No, but it could, right? And at this point, I don't think any side has an advantage right now. The Bears or the Bulls, really, because on a day like today, we could see some retracement tomorrow because we're having such an up day. But the truth is, we are getting that upside action here, and the Qs could keep running. Right? TLT is going to be a big part of this. Look how we're starting to break the 85. Can we hold there? Can we hold there and actually make that move towards like 85, 25, close up there and start getting out of this hourly resistance here. The next levels to watch from here are going to be up here towards this 85.34 level. We'll see if we can get back towards that in that area. If we get back through that, then yeah, this is really looking like a strength move. And where did this come off of? And we all want to make fun of it. But the truth is the Ackman bottom. This is that circle right here. And you see the TLT keeping the strength right now. All right, time to catch up with you guys in the chat. What's going on out there, guys? You guys smash the like if you guys are enjoying the action. And let me know what stocks on your radar. Let's take a look here. A lot of talk in the chat, so I'm going to try to catch up, scroll up, and take a look at some of the stocks that you guys want to take a look at. I see a lot of bulls being mentioned in the chat, so that means new bull market you guys expect out there. That's interesting, definitely to catch. War market equals waste market. Yeah, we'll see what happens on that one. Lockheed Martin being mentioned in the chat. Let's get to some of those and maybe the TQQQ. Well, the TQQQ, of course, that's going to be a leverage to the upside. So I just say take a look at the Qs. If you can get the trend to keep going, that's your friend in a trade like this, right? Is the trend to keep riding and grinding higher. We'll see what happens there. Let's get to some other stocks that are mentioned in the chat. Tesla. I think I saw Tesla mentioned in the chat. Let's do Lockheed Martin, LMT, right? So, of course, this is in the industrial space, which is getting a bounce today. But I've been concerned with these if they would turn around, because if they did turn around, we got to be careful about the industrial names. And you guys see Lockheed Martin's back up there to 452. You can take a look at the other defensive names. NOC has been pulling back a little bit. And then RTX, right? RTX Corporation continuing to climb higher. So I would watch like RTX and Lockheed Martin side by side. Watch what happens to those if they want to continue the trend. One thing you can clearly see is the light blue line here. That's the 9 EMA. And so that's going to help me tell me when the momentum is turned. And that's when the price closes and not makes a move, closes below that 9 EMA. That's one thing that I'll definitely keep an eye out for. And at Benzinga, are regional banks really sound and resilient? I mean, you heard those comments, Carmen. I think that he literally admitted it, but hey, we'll just keep moving. Jay Powell said the banks are resilient and they're about to fail big time. Even Jamie Dimon cashed out of his bank stocks. Something definitely to catch. What about Home Depot? This is an interesting one. Let's go to it. It's been really wrecked as of late. Look at the turnaround there, right? This went down there to an extreme RSI. It was even down there towards like kind of 16. What do we got here? A 6 rating. Wow, that's extreme. And that's when I usually look for turnarounds, right? I talk about this all the time. For me, RSI is only an advantage if I'm looking at what? Extreme price points. So when does this turn around on the bottom? Usually it turns around below 12s. There's not many times where Home Depot has been below 12. And what happens every time? We get a little run right after that. And I could show you this on the chart, how I use it. Now, the big thing to look for also is as you start to see the reversal on RSI, like you got it here, where it went down below this and then started to reverse, look to see if you get up price action with that. And does it continue? Because what did we get here? The price started declining, yet the RSI went down a little bit, but it didn't necessarily go back down towards that circle. That told me that eventually this move could turn around if it could make a move back towards this high on the RSI. And there you're seeing it, the moves back. Now this could eventually get back there to the 300. We'll see what happens if the RSI turns around. All right, let's keep going. We could take a look at some other ones. I'm seeing DKNG mentioned in the chat. DraftKings has been just holding on here. I think a lot of this is just going to determine by what happens and what continues to happen in the gambling space. But one thing to like about DraftKings, if you look at it and compare it to like a Penn, I mean, that's just ugly. Compare it to like a Rush Street, that's also come back down, right? Compare it to anything really kind of in the gambling space, and you're going to see what? That those names have come down, but DraftKings is holding on there. ARM is an interesting one. Will this actually turn around? This thing did go below 50s, now starting to go back above 50s and really starting to push. If the market could keep pushing, ARM could definitely push. What's going to determine on ARM or what will happen in the future? Well, NVIDIA's report is going to really determine what happens there on ARM. If NVIDIA gets crushed on their report, well, yes, ARM will too. And that's what my biggest concern is in this up move, is if we get faked out because we're looking for what? We're looking for tech names to continue to climb. And then NVIDIA comes and shapow gives us that disaster report. Or even worse, what if they come out with a pre-announcement beforehand? Things like this is what I'm concerned about. All right, let's keep going. There's other stocks being mentioned in the chat, Riot and names like that. Keep them flowing there. I'm going to keep going with these names. It's 3:44. We'll go until 4 p.m. and then we'll get you guys over to the Dales report where they'll be talking about some cannabis stocks, psychedelics, and crypto. So if you like those names, stick around. And this is a crypto name right here, right? Riot. Riot is getting a nice little lift now, starting to get above that 1024. And with that being said, Coin kind of is interesting for me here as this starts to lift. Really, if I wanted to kind of trade this, I wouldn't mind taking some shots on this. We'll see what happens there on Coin if it wants to keep going. All right. And of course, you guys can look at Mara with those types of plays, and you guys can see that. That looks like a cup and handle pattern. I'd look for a little pullback to that 9 EMA to try to take part in this, but it could just drive through that sideways period on the 9. And you could see the cup here. Like this is just as good as day as it gets. And now we need to see if it gets the handle. Will it do a little bit of a pullback and then lift higher? That's what I'd be looking for. That would be the cup and handle pattern. Smash the like if you guys are enjoying this action out there, team. I wanted to jump on and kind of cover exactly what I got out of the conference, look into the stocks, and keep you guys going. So let me know what you guys are taking a look at. NVIDIA will not pre-announce earnings, are 3 weeks away. That's a long time. Yeah, and could run before that, right? Especially after an AMD report. We'll see what happens. I mean, the AMD report wasn't great, but that doesn't matter in this case, right? AMD still went higher. I mean, it really wasn't. When you look at their segments, especially the ones that actually run the majority of their business, those were flat, if not negative. All right, let's keep going. Let's see what else is being mentioned here. Amazon looking really good. Yeah, it's pushing. And this should help Shop. I did see Shop turn around today, and that doesn't look too bad. But let's go back to Amazon. Amazon up there to 136.87. Can it get to 137? We'll find out. But look how it's starting to make its way and really starting to push off that bottoming action. We did get an opportunity just on Thursday to see this flip. And of course, that was before their report. They went from being at the bottom of their daily chart, now approaching the top. We'll see what happens. All right. And other stocks that were getting hit also on bad reports, continuing to fly higher, like Wayfair, right? When we're going to start to see stocks like this, where they get crushed in the pre-market, but they want to go higher in the intraday market, that's going to tell me enough that, yeah, we are in kind of more bullish territory. And you got to be careful out there, bears. But look at this thing. This thing went to like 99 already on the 5-minute RSI. And that just goes to show me this is just kind of a bounce, but extreme lows in the pre-market right back up there. Essentially from those lows, up about like 20%. Was the report good? You guys tell me. I don't think this report was the best. EPS at a loss of 13 cents. They were expected to lose 48 cents. So, I mean, maybe you can see that as a little bit of a higher end and a higher outlook because they lost less than expected, but still at a loss, right? We'll see what happens there. Melly reports today. Might be a good day to report. I'll tell you guys that. And that's why you might be seeing Melly rip higher already. And man, that's a drive there off this 348 candle. I don't know what happened there, but to me, this seems like somebody went long there. Big ride up there on Melly. Mercado Libre. See what happens on that one. Sava being mentioned in the chat, getting a little bit of a bounce. I don't trust these biotechs. They don't move as much in these situations, but you can see this is trying to recover. This is why I don't like trading them. You never know when you're going to get a down gap on a biotech. Same thing, like you never know when it's going to continue going. Honestly, I feel like a lot of times when I play biotechs or healthcare, I'm in other people's realms where they have expertise because they understand the products, the medicines that are being made. And I just don't. Let's just be honest. So always knowing where you have edge is vital to staying in the green. All right, let's keep going. Let's take a look at the Kathy favorite. Kathy is bouncing ARKK, getting a little bit of a bounce. Let's see what names are leading there. You guys can see Meta's getting a nice little push, SQ. So PayPal, right? What's up with PayPal, guys? PayPal is due to report when? You guys know it. Let's see if anybody knows in the chat. When's PayPal reporting today, huh? Testing you guys, seeing if you guys are awake. Who knows it? Who knows it? Boba, do you know it out there? Let's see. When does PayPal report? Trying to keep you guys honest here. See if you guys are awake. Well, they report. I'll give you a clue. Tonight, man. Come on. I want to see someone come up with this answer. There you go. I see you guys waking up. I know the YouTube's a little lagged there, but hey, now I see SQ coming back. I see PayPal coming back. This could lean me a little bit more to going with the PayPal report tonight, but it's a dangerous play. That's one thing I would say. So those type of people that like this type of play, then yeah, it kind of makes sense. But the truth is this the time to go after it? I don't know, man. I'll tell you one thing. I will leave this play alone. Every time I mess with like a falling knife like this and go long it, I get crushed. The same way when I tried to go like on, what was that? Burlington, BRL. I tried to short Burlington. You want to know where I tried to short it, guys? On this day. This day here. Oh, I still look at this chart and I wanted to slap myself because what ended up happening? They gave a bad report and it went up on this action. And then the following day got crushed. I mean, that could have been a nice 48% play. I thought it had no business being up there in the 225s. Clearly had some edge there, but got caught. That's where you got to be a little bit careful, especially trying to play these type of plays, right? These turnarounds. PayC, whatever happened to that today? Did this come back? Ooh, it came back somewhat, but nowhere near what I would say is considered a strong bounce there. All right, let's see what else are being mentioned. There you go, Jay. You bringing up some other ones that we can take a look at? I got you, Jay. We can take a look at some of these. Qualcomm, let's go towards their daily, and you can see how they're taking off. This helps, right? Reporting on a day like today is definitely going to help. This stock has been down here at the support around the 103s multiple times, so this one doesn't look too bad. SEDG. Of course, this one already gave some pre-announcement, has been hit, destroyed. Could this one bounce back a little bit? Yes. And that's why I won't be shorting it or going long it, because really, who's to know what happens here in Solar Edge? I know First Solar was an interesting report today, and I was wondering if it would come right back down. I felt like this was a short opportunity, and that one was a short opportunity, even with the market going down. So to me, can I trust SEDG's report today? No, I can't do that one. First Solar should have been one. I should have been looking to short. That's for sure. Didn't get this one though today. All right, let's keep going. We'll see what else is going out there, team. I missed out on AMC short because of a margin call, and that sucks, man. So the big thing there is just maybe don't stick to the margins or try to trade with that cash account kind of thing. That might be able to help you out on AMC, but it is starting to come back down. Square is tonight also. Ooh, is Square tonight? I didn't know Square and PayPal reported on the same day. Yeah. Oh no, that's tomorrow. Square is tomorrow. I'm confirming here. Square is tomorrow after the close. PayPal is tonight. So I would lean more to PayPal than Square, but PayPal will move Square. And so at that point, they might actually lift the bar for Square. And then on Thursday, Square could come back in and knock it back down. So just be careful out there, traders. It ain't going to be easy. All right, best play of the week, GNRC. Great buy. Yeah, I mean, honestly, maybe when did you buy this, Nick? Did you buy it today? Did you buy it before? When did you buy this? Because it's all determined on when you bought it. Could I expect this report to have gone higher? I'm not so sure on that. I mean, why was Generac getting hit in the first place? Well, it's because it's high expensive. It's an expensive product, and to get a lot of those Generacs, you're going to need to get it in financing. Of course, higher interest rates, making the Generac more expensive and lowering the demand. Nick said at 85 he got it. All right, so you were getting it down here essentially. Did you get it before this day, or did you get it on the breakout? Because if you got it on the breakout today, then shout out to you, man. That was a good move. But this thing did break out in the morning, so that's a little bit harder to play. Maybe you were playing it yesterday, but I don't know how you guys do it. I wouldn't be able to sleep on a report like that. Literally, this move also would have been freaking me out at 4:15 a.m. So I don't know if I could have been played in that one. All right, let's keep going. We'll see what else is going out there. It's 3:54, guys. We're going to wrap it up here in just 5 minutes. We'll get you over to the Dales report. That's coming up next. Don't go anywhere. We always got a lot more for you guys right here, always on Benzinga. We're going to get into some cannabis psychedelics. I saw that Cybin has some important news. And where did I learn about Cybin, and especially the news that's coming out right now? Well, of course, I learned that where? Right here, of course, guys. On the Dales report that's coming up next. Don't miss that, guys. They get some really good insight of what's going on in the industry and keeping you attached to all the latest action. They'll be talking about MSOS and kind of those types of stocks. So stay tuned for that. That starts at 4:10, team. All right, let's take a look here. 85, 86-ish. I got it yesterday before the close, and I was freaking laugh out loud. Always contingent interest rates. Yeah. I don't know how you do it, Nick. Honestly, I would not be able to sleep. I do swing trades, and those already affect me. I couldn't do swing trades on an earnings report. It just would scare the living death out of me. And I have done it, and it usually never goes well for me. That's also another thing. Know what works for you. Know what works for you, and know how that's different, right? Stats and results speak for themselves. All right, let's get back to the SPY. The SPY continuing now 422.89. Let's go to the Qs here as we're at 357.42. And I'm sorry, I just hit my camera here and my camera went down there. Man, it's been a struggle today with the camera. Now we're getting more struggle there. There we go. Get your camera back on, Mitch. Come on. All right, there we go, guys. Sorry about that. DSLR issues. Q's going higher to 357.50s. Let's go towards the TLT. This is what I was thinking about, would tell me that, yes, this drive could continue. A move above 85. That's what I was looking for. Now we're above 85. Even did a dip down below 85 on the 15 minute. We just dipped below that, right? 84.88 on the recent 15-minute candle. So at this point, if we stay above 85, I need to be looking for what? Renting trades to the upside. That's what I'll be thinking. What do I mean by renting them? Is that I won't invest in these names, but can I trade them higher? Yes. And that's definitely something to look for. Holy moly, my camera is just not cooperating today, guys. All right. Well, I'll just stay to the charts. I'll probably just take my camera down here and just wrap up the day in just a second here. But definitely wanted to get this guys a nice review here. Financial services are getting a little bit of some strength here. And I think that they could kind of grind higher for a little while as we start to see this lift. And of course, seasonality comes in. Now, where I get a little bit confused, and it's something to keep an eye out for, is this XRT trade. I've been talking about this trade for a while. I've even taken it, have made money, have lost some money on this trade. So it's been back and forth on it. But I do see bottoming action coming in. The market's starting to show reversal. So I'm going to keep these names on my radar. It's up to you guys if you guys want to take a look at these names. But names like Amazon, Walmart, Costco, TJX, O'Reilly's, Target even going higher right now. Ross Stores, right? I mean, if the consumer's pressured, they're probably going to Ross to save some money on their closing. Kroger is going down there. DG not having the best day. Dollar Tree, eBay getting a little bit of a spike. Ulta finally getting some strength. This is one I've been wanting to take a swing trade in. Ulta, if it could get back through this 386, I don't mind taking a shot. Will ELF finally bottom and start to come back? Things like that we need to keep an eye out for, right? XRT, of course, has a bunch of different names in it. Best Buy has recently started to get back on my radar, as it seems like it's been bottoming out and could get a little bit of some seasonality lift. All things to kind of keep in mind. We'll see what happens with these. Definitely getting a little bit of a bounce. KMX, CarMax, getting a little bit of a bounce and definitely oversold, as this thing has just dropped off like a tank, about 30% in the red for the recent month. And even Chewy, it's red right now, but could this thing squeeze? Man, I've seen Chewy squeeze before. So I'm going to keep this one on my radar to see what happens with this one. How will I look at it? I'll look at it on an hourly chart. If kind of tried to fill the gap here, couldn't fill the gap. If it goes back down below 1850s, I won't think about it on the upside. But if it can get back above 1950s, oh, this is going to be looking good, team. I'll be watching for a move into 1950 tomorrow on Chewy, and it might make it even overnight. So watch out there, team. This stock likes to make moves. And of course, we got a bunch of earnings reports. You guys can keep up with all the earnings reports. Where? Of course, you guys can keep up with all the action. And of course, on Benzinga Pro, of course, you guys see that in the top right corner. You guys see the QR code. You guys want to check that out, definitely hit that. Or you guys can keep up with Benzinga Pro, of course. Go to pro.benzinga.com. Get your 2-week trial today, team. I will see you guys bright and early, of course. Stick around. There's always more for you right here. Up next, you guys got the Dales report. We'll talk a little bit about some cannabis action. And we'll talk even about like companies like Cybin and things like that, psychedelics. Who wants to talk about this industry or maybe just learn something new? And I'll tell you one thing, they're a really fun watch, great personalities on the Dales report, led, of course, by Dale and, of course, Anthony and Ben. So if you guys want to check that out, that's starting up in just a couple of minutes, about 8 minutes will be started up. But stick around right here and talk about some trading. What did you guys enjoy today? What caught you by surprise? And like always, we'll see you guys bright and early on Pre-Market Prep.